Okay, seeing from Stacy, yes, you can hear me. Simon as well confirming. So thanks. Cool. So we'll kick off this session. Um, like I said, today's session is on, we're still doing part of the Personal Financial Wellness course. And I'm still your trainer. My name is Michael. This is last week, we basically went through, first week, we went through the fundamentals, which is basically around um, time value of money, compounding interest, and how to calculate your net worth. And we spoke about why net worth is the most important number that you should really focus on. And then we spoke about budgeting. Then from there, we've done savings. We went through some tools that you can use for saving, and we talked about how to build and control debt. And then in today's session, we will then go through how to investment, and basically as the most important piece for us, because investment is part of how, what really helps you to grow your net worth, because you can really increase the value of your assets considerably if you invest in the right way. So I'm just seeing the screen isn't changing as I'm moving. So I'll just stop sharing my screen and then I'll share it again, just to make sure that we're able to follow as I move the screen on my side. Okay, requesting if you can confirm on your side if you can see the screen. I just want to make sure that I am able to present and you can see the screen clearly from your side. So maybe just on the chat, if you can write yes or no if you can see the screen. It's for me to be sure that we are all able to see it and we can follow. Okay, seeing Mercy saying yes, Genevieve as well, you're saying yes. Cool. So I think let's get started. At least we are done with that technical hitch. Apologies for that. So what I was saying is we're basically on the third week of this course. Basically, next week would be our last week, and today we'll be talking a lot about investment, different types of investment. We'll talk about stocks in detail. We'll talk about money market funds, and we'll talk about a bit about balanced and equity funds. And then one of the most important concepts that we'll talk about will be the risk-reward equation or pyramid, which is usually very important, especially when you're trying to analyze which investment method you should go with. So that's basically what we're going to be going through today. And as always, we start off with house rules. I always say this session is for you. In this session, feel free to ask questions. Let's be as interactive as possible. And as always, what happens in this classroom, let it stay in this classroom. If somebody is comfortable enough to share some examples, to share a few things with the other people just to get a bit of help, let's keep it here. And at the same time, feel free to ask questions, because the more you ask questions, the more we can be able to help each other. If you're thinking it, probably someone else is thinking it as well. And they're just trying to find their ways to ask it. So feel free to ask it anytime you're thinking it. So I always like to start off with a question, just for us to be able to know each other and to make sure that we are following, and just to make it a bit of interactive. So today I have two hopefully interesting questions, interesting as per my own judgment, but I hope it will be interesting for everyone to share. So I just wanted to ask, what was the last time you spent money on something that made you smile? And then what thing was this and how did you finance it? So I think I could get started. So the last time I spent some money on something that made me smile was in August, when we took a bit of a trip with my family. We managed to spend about 2 nights out. It was really, really fun. And in terms of how I financed it is, I did save up for it from the start of the year. It was actually supposed to happen towards the beginning, but then we only managed to go out in August. So that was the thing that made me happy. So if if somebody feels comfortable to share, you can either write on the chat or you can unmute. What was the last time you spent some money on something that made you smile? It could be buying yourself a new pair of shoes. It could be buying a new dress. It could be as grand as a holiday or as small as something that just made you smile. So whatever it is, feel free to share it. Just giving everyone a minute or two to think about it, and then we'll get on the class. So WF, you're saying you can't hear me. Maybe you might want to check that you're connected to audio, that you have joined with audio. I'm hoping the rest can hear me. And it's only WF who has a problem hearing me.
Hi everyone.
Has somebody unmuted? Maybe you want to answer. Just give it a go. There's no right or wrong answer. It's just, and I'll tell you why I'm asking this question. So feel free to answer in the chat box or on the to unmute and answer. I can see Ruth, you've unmuted. Do you want to give it a go?
I'm not sure that you can hear me. Am I clear from your end?
Okay, looks like Ruth is not able to answer. So I think let's proceed just in the interest of time. So I always like to say this. So the reason why I had those two questions is because the aim of what we're trying to do, especially when you're looking at your personal finances. Yes, Stacey, you raised your hand. Go ahead, Stacey, you can unmute.
Hi. Hi, hope you can hear me.
Yes, I can hear you.
Oh, okay.
I'm just trying
so
to see my volume so that I can hear you.
Trying to?
Go ahead, Stacey.
Sorry?
I can hear you.
Oh, okay. So the last time I spent money, I bought we have this Notify shelves going on, Notify logistics.
Yes.
Yeah, so I got some shelves, and finally last month I got my first monthly investment, and I was really happy. Well, where I got the money for saving, that is through tips from people.
Through, I didn't get the last part. You said through what?
Through tips.
Or tips. Okay.
Yeah.
Was this like at your workplace?
Sorry?
Was this like at your workplace?
Yeah. Yes. I work at the airport, so the tips that you get maybe from different passengers.
Yes.
Yeah. So I gathered all that and bought 3 shelves from Notify.
Good stuff. And that made you smile. I think that's an amazing way to show how you can find side income sources and kind of use it to fulfill your other needs. So that made you smile. That was something that you're happy. I can see Ruth as well as answered. So she seems to have an issue with audio, but she bought herself a phone that she always admired, and she used her savings. That's also brilliant to hear, Ruth. Thank you for sharing that. So thanks, Stacey. Thanks, Ruth. I don't know if there's anyone else who wants to share. If not, I think we can continue. So I see Lorna says, Stacey, is it Schultz? I can't get what you are saying exactly. Stacey, I don't know if you've seen that. There's a question from Lorna to you.
Yeah, what does she mean by Schultz? Is it Schultz? Like,
she's asking what you bought. I think she's not getting that you said shelves.
Oh, sorry, shelves.
Yes.
We have some. In Notified Logistics, they are selling some shelves that you can purchase for 1,000. Then they send you like a regular income per month. That is 2K per month for the whole year.
Perfect. Looks like she's got it. Good. So I think the reason why I was asking those questions is we're not going through this course for us to live the life of a poor man or a poor woman. We're not trying to say if you have an income, don't enjoy the money that you have. Wait until you're 50, 60 before you can even go on a holiday. But we're just saying be practical. So live within your means. Try to save. I'm happy to hear that everyone who has given an example. What you bought, you financed it through savings or through finding side income, which is the right way to do it. And then when you do make a decision about taking debt, then it's the right decision because you're using that debt to then buy an asset that will by and large help you to increase your net worth. So that's the reason why we are doing this course, and that's the reason why we are going through this together. We're not trying to say, jifinyilie, don't spend money on anything that makes you happy. We're trying to say, spend the money in the right places and still find the time for you to have those happy places every once in a while. So for today, I think I already went through what our agenda is. So in terms of investment, we'll just get started. There's this quote by Jean Paul who says, to know what life is worth, you have to risk it once in a while. And it's a perfect quote for us to start off the risk-reward assessment that we need to do before you take on any investment. So usually any investment can fit in one of these 4 boxes. And at the very bottom, you have what would be short-term investments. This is usually when you need money within the next 1 to 3 years. And then we have medium-term where you need money within 3 to 5 years. We have long-term investments that you don't need the money anytime soon. You need it either 5 years or later. And then you have the very high stakes investments, which of course are very high risk, but the reward could potentially be very high. So when you look at this, just to give you an example of each of them. So stocks usually comes in about the medium term to long term place. And then you have things like bonds, government bonds, corporate bonds, which usually come in around the medium term usually. And then at the very high stakes place, you have things like Forex investment, you have things like Bitcoins, cryptocurrencies, which would be very high stakes. You can easily lose your money, but if you have a bit of luck and a bit of knowledge and you invest in the right time, then you can be able to make a very huge investment back. And then we have the short term, which is usually things like savings accounts and money markets, which are they don't have as much risk, but of course the reward also is a bit lower especially when you invest in those ones. So the question would be, how much risk do you need to take? It really depends on 3 things. So the first thing it depends on is your financial goals. So remember when we started off, we said set financial goals because those would be very important for you and they'll guide all your decisions. So the financial goals will do 2 things for you. They'll help you to understand how much money you need to accumulate and over what period you're trying to accumulate. Remember, the investment pyramid also puts in the duration in which you need to invest. And I'll give you a very good example of stocks so that you can see just how cyclic they are and why it's important for you to hold on for a longer period than just investing if you need the money within 1 year or 6 months. So in terms of financial goals, the thing to ask yourself is those 2 questions, and then basically your investment decisions should reflect your wealth creation or your financial goals. The second question is you should ask yourself, what is your time horizon? How long can you leave your money invested? If you need the money sooner, of course, you need to take less risk because you will not be able any small shock can easily make you lose your money and you won't be able to take it. But if you're looking at a longer time horizon, then you can take a higher risk because the reward and the time that you wait will definitely pay off. And then lastly, you have risk tolerance, and this is just your own internal metric. So how risk averse are you? So I'll give you a very simple metrics that we'll go through for you to understand how risk averse you are or how risk tolerant you are. So when you see a lion coming towards you, do you fight it or do you try and run away? So that's kind of the question that you're trying to ask yourself. So you should take less risk if you cannot afford to lose your investment or have its value fall. Okay. So in terms of how do we account for time value of money, if you remember we spoke about especially when you're investing, it's important for you to remember something, the concept of time value of money, because what the purchasing power of 1 shilling today will not be the same as the purchasing power of 1 shilling next year. So this is what we call inflation risk. So usually for us in Kenya, our inflation rate is usually between 4 to 5%, meaning our money loses 4 to 5% of its value every year. So if you had 100 shillings today, what 100 shillings could buy you today is not the same as what 100 shillings will buy you in the next 5 years, because the 100 shillings will have lost 5% of value every year. So let's illustrate that with an example. I don't like using just abstract theory and not necessarily using examples. So we've used these ladies all through the course. So we'll use the same two ladies. We have Jane on the left and we have Joy on the right. So Jane invests 100,000, and the return on her investment, based on the choice that she made of where to invest it, she invested where it's 5%. So after 3 years, she will have 115K. And once you factor in inflation, what you find is that the 5 minus 5 is actually the real return on her money is just about 0%, because the 115K will only be able to buy what was worth 100,000 once after those 3 years, because it will have simply been eaten up by inflation, or basically the time value of money. So on the other side, we have Joy. So Joy invests where she gets about 8% return. So after 3 years, her 100K is worth 125. And from an inflation perspective, inflation is 5%, sorry. So what that means is that the real return on her investment is 3%, which would basically be the 8 minus the 5. So her money, she can basically buy 3% more than what she could buy 3 years before, because she's basically invested in a place where the return on her investment is higher than the rate of inflation. So it's important for us, as we go through this personal financial wellness course and this journey, it's important for us to always look at what is the real return on our investment. And it's as simple as just looking at, after 1 year, how much money do you have versus how much money did you start off at the beginning of the year. And based on that, make sure that the money that you have a slightly higher amount than what you started off, and let it, as much as possible, be higher than 4 to 5% of what, because that's what the inflation rate is in our country. So this is what to ask yourself for you to know your risk tolerance. So today, let's say you had invested 100,000 in stocks. So you had bought a bit of Safaricom stocks, you had bought a bit of KCB stocks, or maybe any other company. Or if you're not a huge fan of stocks, you can use any investment. So you had bought land worth 100,000, maybe that's how you invest. Or maybe you're the kind of an investor who had put in money into the Forex fund and things like those. So you had bought Bitcoin, whatever it is that you'd invested. So ask yourself this question. So if your investment today, you put in 100,000, if you went in and checked the value and you found that your value of investment is now 90K, what would you do? Would you decide to sell so that you keep the 90,000? Would you decide to just sell a bit of stocks because you're trying to get rid of the bad ones and keep the good ones? So maybe you find within your stock portfolio, you find that Safaricom is doing well, but maybe some stocks like Bamburi Cement are not. So you say, let me sell Bamburi, but I keep Safaricom, or vice versa. Or do you do nothing? So do you just decide, I will wait to see if it corrects? Maybe it's just one of those downs, but it will correct. Another scenario could be you decide to buy more stocks because you're like, today the price is down, but it will go up. So let me find an extra 10K, put it there. And then once both my 90K and the 10K increase, I will have 110 or 120. Or do you decide, I'm willing to bet even more? So rather than just adding 10K, you decide, let me add 50,000 because I want to buy a lot more when the market is low, so that when the value goes up, the value of my investment also goes up. So this is how you then rate your risk tolerance based on this. So if you chose to sell and keep the 90K in your account, you would say you have low risk tolerance. If you said you'll do nothing, or you're there in the middle, thereabout, you have medium tolerance. And then if you said you'd buy more stocks or you'd buy a lot more, then you have high risk tolerance. And based on this, if you have low risk tolerance, then go to ways that would really preserve your money. So this would be like savings accounts, this would be like money market funds. And if you have high tolerance, then stocks and then stuff like Forex would really be the stuff for you, because you have a lot more nerve in yourself for you to accept shocks that come from your investment. So I want to just check that we are together here before I proceed. Just checking in case there is any question as well, at least on the aspect of the risk return and all that. I'm not seeing any question in the chat, but I just want to give anyone who has a question a chance before we go into the next part. Yes, Lorna, I can see you raised one.
Yes, okay, my question is...
Yes, go ahead.
Unanisikia?
I can hear you, yes.
Okay, on this Forex investments, you'll hear that they'll tell you that a return of like 7% a month, it's not, it's too risky. So like you should expect a return of 2% monthly, and then like annually it will be to 24%. Okay, so I want you to like tell me ni range gani ya like the interest, like the percentage unafaa kungojea when it comes to Forex. Second question now, how do you, okay, especially the Kenyan stocks, how do you get to know which stocks you're supposed to invest in? Because unapata, like, okay, from my observation, you'll find that Safaricom, like, iko na investors wengi. And then, like, now at least ndio iko chini, like, kununua and all. But then you find that other high-performing stocks, ziko ni 3 so per stock. Okay, how do you actually get to know which stocks to buy? That's the question. Yes, thank you.
Cool. So I think you've asked two questions. The first one is on Forex as an investment. So what is the ideal return, if I got that first question correctly? And then the second one is on how to choose the right stocks. So first of all, just checking that I got the two questions correctly, right?
Yes, that's correct.
Okay. So I would say in terms of Forex investment, I think that the real... Usually for the people who have seen investing in Forex, they usually get anywhere between 20 to 50% return. But that's usually the average once you look at the investment over a whole year. The two things I would say is, once we go back to the pyramid that we were looking at, what you'll find is that something like stocks is very high on this part of the risk. So stocks is very high stakes, and the risk that you'd then be taking on when you invest in stocks is really high, versus something like, Forex is here, sorry, I'm confusing myself. So Forex is here in terms of high stakes, and then something like stocks would be somewhere here within the long-term hold and the medium-term hold space. So it's a bit lower risk in terms of stocks versus Forex. So what I mean by that is, this year your return could be between 20 to 50. Next year your return could be a negative, or could be just maybe 1 or 2%, because there's a lot of factors in play in the market. So how do you make sure you have a consistent return? I would say, first things first is make sure that you're knowledgeable. The biggest investment you can ever do, especially when you're taking on an investment journey, the biggest investment you can ever do is by making sure that you read hard and do your analysis well before placing any trade. So using the example of Forex, if you were to decide today you want to buy the dollar and you think the dollar will increase in value, what really is the reason why you think the dollar is going to increase in value? Don't make it anything about emotions. Let it be hardcore facts that really make you say that I believe the dollar will increase in value. And based on that, and if let's say you don't have the hardcore facts, then don't really take the trade, because otherwise, it being high risk and you not having the facts, then remember you're just basically saying that you're kind of betting money. You're not really taking an investment. There's a difference between investment and betting. One, betting is where you put money and you hope it comes back, but investment is you put money and you're sure it will come back. So one is risky, very high risk betting, especially because there's no science or there's no facts to back why you decided to take what you took. But then in terms of investment, if you do your research well, you will get the right value. Then the second one in terms of stocks, so we'll go through that a bit more in detail very soon. But again, I would say the same things. So number one, understand the company's value, understand what their numbers look like. So how much profit have they been doing? Look at their longer term performance. So it's important for us to do research on how much their profit has been, how much their revenue has been, and things like those. And then you basically find the time when their stock is underpriced, because that's where you want to buy, and then basically ride when their stock is going up, and then you basically sell. So you have to do the research for you to then be able to decide when to go in. And in all of this, don't put in any emotion. Don't say, I feel like Safaricom is going to do well. You don't have the math, you don't have the facts to back it, but you just say, I want to buy Safaricom, and then you go and buy. That's betting, that's not investment. So I hope I've answered that question, those two questions, Lorna.
Yes, thank you.
Perfect. So I think let's continue to the next section, which is on stocks, and going through a bit more detail in stocks. So like I said, the best investment you can make is an investment in yourself. The more you learn, the more you'll earn. So always make sure you do research before you take on an investment, because if you don't do the research, you're simply betting your money. You're not really investing. So in terms of understanding stocks, so let's start off first from the unknown. So let's try and figure out what are stocks, and then we'll go through the basically a bit of information about how to choose the right stocks. So stocks are basically you buy a piece of ownership in a company, and stocks can basically go up or the prices can go down. Today you could buy at 20, and tomorrow your stocks are worth 30, and today you could buy at 20 and tomorrow your stocks are worth 18, because stock prices are usually just indicative of what the market feels the company is doing. The company could be doing very well. For example, what happened with stuff like Netflix and Zoom this year, they were doing very well when people were in lockdowns. And then all of a sudden, when the vaccine has been announced, when people know that people are going to resume their normal lives, then basically the prices are coming down, because the market no longer feels that the stocks are valued as highly as what they were valued previously. So it's important to understand that stocks are usually they're not really representative of the value of the company. They simply represent what the market or what the investors feel the company should be valued at. If they feel the company should be appreciating in value because they are likely to give more profits because they've done a big announcement, then the prices will go up. But if they feel the company is likely to lose revenue, then the prices will go down. So what makes up the stock prices change? I think I've alluded to this. So if the company says or invests and says that they have increased revenue or increased their profit for the year, then the stock price will go up. If the company invests in a new trend, for example, when Safaricom invested with fiber at home, that of course meant that their value would increase. This year, people have been betting big on Safaricom because they have invested in fiber, because people being at home, they're making more calls. They're connecting a lot more using data bundles, because you have to do WhatsApp calls, Zoom calls for you to be able to interact with your family, your friends, and your colleagues. So as a result of that, of course, for example, Safaricom prices will go up. And then we have situations where companies buy other companies, or a company is bought by another company. So a good example is when KCB took over National Bank. Of course, National Bank stocks went up right before KCB basically bought them, because investors wanted to take the price of the company a bit up so that they can make money when KCB basically buys them out. And then lastly, competitor activities can also affect. So it's not only important for you to look at, if you're, say, for example, trying to evaluate whether you should buy, using an example of like KCB stocks. So don't only look at what KCB is doing, but it's important to look at what other banks are doing, because based on what other banks are doing, those could indicate what will happen to KCB. Because remember, they are playing in one sector, which is trying to bank people. So if today Equity makes an announcement that they've removed all their charges, which is what happened a few years back. Equity came in with the strategy of trying to bank everybody and not necessarily shutting off people with low income and people without regular income. So because of that, you saw equity prices go up, but then you saw banks that refused to follow the same trend, like Barclays. You saw their prices coming down. So it's important not only to look at the company you want to invest in, but also look at the companies within the same sector who are their competitors and see what their competitors are doing for you to then decide whether you feel the price will go up or go down. So one thing that people forget to do, especially when you're buying stocks, is they forget there's always a commission that is charged by your broker. So this is just an example. I picked this off one of our Kenyan brokers, just to show you how they charge fees and commissions. So these guys, for example, charge you a fee of 2.13% if the amount that you've transacted either by buying or selling is below 100K. And if it's above 100K, they charge you 1.84%. And on top of that, they have an annual maintenance fee of 1,200. Whether you make money or not, they charge you 1,200 shillings every year. So imagine a situation where you've bought stocks, you've put in your 100,000 shillings, they charge you 2.13 the moment you buy those stocks. Then the moment you try to sell those stocks, then they charge you another 2.13, because they charge you on both sides. They charge you when you buy and they charge you when you sell. So you really have to make a profit of more than 4.2%, because that's the only way you get back both the fee that they charge you and on the buy and the fee that they charge you on the sell, and plus you make a profit. So really, if you bought stocks worth 100K, you have to wait for your stocks to be worth 110. Otherwise, you'll have basically lost money if you try to sell at 104, because the 2K will have gone to fees on one side and fees on the other side. I don't know if that makes sense, but feel free to stop me or ask a question in case it does not make sense. So it's important for you to see the fees. And remember, for the full year, you must as well make the 1,200, because otherwise this will still bring your return on your investment to be negative. Because if you don't make 1,200, then you're simply going to lose money. So not everyone has an annual maintenance fee. Some of them don't have annual maintenance fees. So this one, I just use it more from a dramatic perspective. But usually the fees on the buy and the sell, they're usually within the same range. Most people charge between 1.5 and 2.5%. So this broker is somewhere in between. They're not really the most expensive, and they're not the cheapest broker from this example. So how do you earn money with stocks? So stock prices can go up, that's appreciating value, and they can go down. So of course you don't earn money when they go down, but you make money when they go up. And then stocks can pay you dividends. So sometimes some companies announce that they're going to pay dividends back to their investors, and their dividends are usually dependent on the profit that the company has made, or sometimes they're also dependent on the revenue of the company, and then maybe saying, okay, we might not have made a profit this year, but because maybe last year we didn't give as good a dividend as we should have, then let's still give a dividend this year, because we want to reward our investors and give them back some good return on their investment. So that's two ways in which you earn money. But then for you to earn from dividends, there's usually a cutoff date for each stock. So maybe you'll always hear, if you have, say, for example, KCB stocks, you'll always hear that you have to be on the record by maybe 30th of June for you to get paid your dividend on the 31st of July, something like that. So always be careful that you know when you need to be on the books for you to then get your dividend. And then the other thing is, before a company pays dividends, there's usually investors who get into the company. So they buy, especially the big institutions like banks, insurance companies, they basically buy the stocks because they want to get the dividend. And then once they get the dividends, they basically sell the stocks and they buy more stocks. So sometimes some especially if you have a lot of money. For the big companies like banks and insurance companies, that's part of how they really make increase their return on their investment, because they keep buying stocks at the time right before they pay out dividend, so that they can earn the dividend and it becomes part of their return. So it can also be a strategy, especially if you have money. But then remember, there's that 2.13% fee, or 1.8 depending on how much you've put in, and that will really affect your return on your investment. So let's look at this example and why I strongly believe that stocks, if you want to invest in stocks, you should be in it in the long term. So the graph that I have here is just, it's what is called the NSE 20 index. And it basically has some stocks like the ones I've put on the right. So they have Barclays, which is now ABSA. They have Equity, they have KCB, they have Bamburi Cement, they have National Bank, they have Nation Media Group. Of course, National Bank is no longer there. But they have Nation Media Group, they have KenGen, and all the way till Britam and Safaricom. So just as an example, this is not all the companies that are included in the 20 share index. So the prices shown here are basically collectively the prices of these shares plus the others that are included in the index. So what you see is, I just wanted to focus on a few peaks and lows for us to see what was happening at the time. So about 2013 all the way to 2015. So if you bought the stocks in 2013, you see you were in for a good ride, because the stock prices went up. 2014 they went up, and in 2015 they hit the highest that they've ever reached in the last 10 years. So you can see that peak that I've circled there. And then from there, the stock prices went down, and then they came up again in 2017, came down in 2019, and even now in 2020, the collective performance of those 20 stocks is really not as good. You can see it's still lower than the highest peak it was before. So what happened between this highest peak and why did we have this very big low? So one of the big companies we can attribute to that is Kenya Airways, because that was the time when Kenya Airways really just stopped being the pride of Africa, and a lot of things happened in Kenya Airways. So Kenya Airways was a big part of it, but we also had other stocks like Bamburi Cement, which were part of the 20 index, and they were not performing well. We have banks like National Bank, of course, which are not doing very well, and those basically account for this dip that we had between 2015 all the way till 2017. And then you can see from 2017 the prices went up again. This, when you do a bit of research, what you'll find is this was the time when some of the banks started following Equity's strategy. Remember, Equity was the first bank to come up with the strategy of trying to get everyone to open an account. And this was when the other banks then followed the strategy. And as well, Safaricom was starting being noticed as an important company. So this is when Safaricom came into the index, and that's why the price also went up. So Safaricom and a bit of banks, this is what helped that. And then you can see from there, the prices went down. So what happened in 2018, 2019 was that we had banks especially. So if you remember, we had the rate cap law that basically limited the amount of interest that banks could charge on loans. And therefore, banks really, they really hurt in terms of stock, because they could not lend out as much money, and therefore their profits really suffered. So because of that, we had this dip from 2018, 2019. And then you can see when the rate cap law was repealed, which was about here, it's the one circled in red, but it's about the same time. So when the rate cap law was removed, you can see that prices did come back up a bit, but then they've been down because this is now 2020, and it's when we had the coronavirus and everything. But you can see there's still a small high, which is what I've circled there in yellow, because that small high again just happened recently when we've started recovering our economy. And of course, from all this, so two things that you would read is that the stock prices should definitely start coming up, because this is the lowest they've ever been. So they could either go low or they could go up. So this is where your risk reward and your risk appetite comes in. So based on just this understanding of the index, if you're a low risk investor, you would decide, okay, let me wait for the prices to start coming up and then take my decision to buy so that I can ride the up. But if you're a high risk investor, then this is the time to buy, because you could buy a lot of stocks now, and then when the prices start coming up, then you basically your investment increases as as the value of your investments increase. So what I'm trying to say is the reason why stocks are a long-term game, because you can see between this point here, when the prices were low, and when they reached their highest, it was between 1 to 2 years. So of course, between here up to here was 1 year. So you could have bought here and sold here, which was about 1 year. But if you waited to the highest point, that was about 2 years. If you look here, so this was another low that happened around 2017. So in this low, what happened is the stocks hit their lowest, and then basically within another 6 to 12 months, they increased. And that's why, again, it's an important game. And then lastly, within another 6 to 12 months here, you can see that the prices really went down. So if you're only in it for the short term, so you're only in it for 1 to 2 years, you could have got in here and lost all this, because within these next 2 years, the prices really went low. And even if they went back up high here, they didn't go back to the same level that they were before. So the thing I'm trying to say is stocks are really a long-term investment game. And that's why I think it's important, especially for you to choose the right stocks. Because if you had bet on Kenya Airways about 2015, 2016, you'd have lost a lot of your investment. If you had betted on Safaricom or on the banks, you could have really gained a lot in terms of your investment. So you really need to do good research. And that brings us to the next point of what should you choose? What should you use to decide when you're picking stocks? So the first thing is do your research. So with most investment brokers, what they do is they always give advice to their clients, and it's usually free. The moment you open an account with them, you can sign up. They could be sending you something on email, or on their website, they could have a section where they post their expert analysis. So do your own research. So they could be saying, basis their expert recommendation, they think you should buy banking stocks, or they think you should buy manufacturing stocks. But use your own analysis as well. So compare different investors, read stuff like Business Daily, read what's happening in the global world, because I can give you an example that's usually very unique. In the manufacturing sector, the price of oil usually links a lot with manufacturing stocks. Whenever the price of oil comes down, the price of manufacturing stocks goes up. And whenever the vice versa, when the price of oil goes up, then the price of manufacturing stocks come down. Why? Because for most of those companies, oil is usually an important input when they're manufacturing their products. So do your own research, read on the internet as much as possible. The good thing is a lot of that is free, so you don't have to pay for it. So do your own research and make sure that you choose the right stock. So then, as I mentioned, do an analysis. So if you find that today could be the right day to buy, don't necessarily buy today. Waiting a day or two wouldn't necessarily mean that you'll lose everything, because stock prices don't go from the lowest to the highest within a short time. Like we saw, it's a long-term game. So do an analysis, see whether, in a week, does your strategy still hold? And if you find that your strategy holds, then that's when you take the risk. So if you find that you had decided, okay, I think I should buy Safaricom stocks, then give it a day or two, because remember, you're not an expert in this case. So the experts would say, I'm willing to bet the money because I'm very sure. But because we are not experts, then we kind of wait to see what happens 1 week later. And if what you thought was right, then if the price was 30, it will have gone to about 32. Then at that point, you can decide, okay, let me do this, let me buy, because I think it's at 32 now, but I think it will get to 35. So I still have to about 3 or so shillings per share that I buy for me to gain in terms of value. So conduct your analysis, and that will help you to pick the right stocks. Then the third thing is spread your risk. So if you have 100,000 to invest, don't take your 100,000 and put it in Safaricom. Take your 100,000 and divide it into 3 or 4 parts. So say I will put 25K in Safaricom, I will put 25K in Kenya Airways, I will put 25K in National Bank or KCB or any other bank, and I will put 25K in Britain. So because you've spread out your risk, what will happen is you'll be able to do a proper analysis to see which of your analysis came true. And based on that, you can say, once you start seeing, say, for example, Safaricom prices coming down, you can maybe say, okay, let me sell Safaricom because I think I was wrong on my analysis there, and instead buy a different stock. So spread out your risk as much as possible. Don't invest in one stock. And then lastly, as I mentioned, don't use any emotion. Emotion is the worst thing you can try to put in when you're trying to pick stocks or to invest in any place. Don't let your emotion cloud your judgment. If it doesn't fit the research, if it doesn't fit the analysis you've conducted, then don't invest in it. If it comes from your heart, you think, oh, I think KCB is going to do well, please don't listen to your heart. Listen to the facts, listen to the experts, listen to the analysis that you do. So for me, that's how I would say that's one of the most important ways for you to choose the stocks that you can invest in. So again, I want to pause, check in case we have any questions. I'm not seeing any on the chat, so feel free to put any on the chat that you have, or feel free to unmute and ask in case there is any question or anywhere you think I was not clear. Or you can just type in the chat box all clear in case you're all clear, just so that I can know we are together and you can hear me and I'm not talking to myself on mute the whole time. Okay, Lorna, you're saying all clear. Mercy, you're saying all clear. Perfect. So happy to hear that. But in case there's a question, please feel free to type it in the chat box and we'll tackle it as we go. So the third part is we look at pooled funds. Last time we looked at them for savings, but you can also use them for investment as well. So there's this famous quote by Warren Buffett, one of the best investors. If you actually want to learn a lot, you can read a lot of the stuff that's written about Warren Buffett. You can be able to watch video interviews that he's done and just learn from his strategy, because for him, he uses a strategy called value investing. It's not easy for everyone, and we won't go through the details of value investing, but you can read up a lot on the internet, because it's one of the ways in which you can conduct analysis and decide which stocks to pick based on that strategy. So he says that diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. So what he's trying to say is, if you know what you're doing, do diversify your investment. So in as much as, yes, stocks is good, Forex is good, and many other ways of investing are good, please look at other methods for investing as well, because the more you diversify, the more you spread your risk. So just as a reminder, what are pooled funds? So like we said in last week's class, we'll go through this section pretty fast because I think we did it last time and we don't have to go through all the details. So money market funds, these are basically pooled funds where basically they invest in short-term instruments. For example, they take the money within the pool. So they take money that I've put in, money that Mercy has put in, money that Stacy has put in. They take that money, they invest it in cash, they invest it in treasury bills and bonds, and basically they find low-risk investments. So usually with money market funds, you will never lose your capital. So if you put in 100,000, they cannot give you a return. They cannot give you 99,000 back. The worst case is that they will give you your 100,000 back. So the thing about it is, it's great for short-term savings or investments, because you can always access your money within 2 to 4 working days. If you ask me, should you take money market funds versus should you invest in stocks? I would say, especially if you're starting off and you have a very small amount, invest as much as possible in money market funds, because like we showed in the example last time, money market funds will easily give you a return of between 9.5 to 10.5%. That's before tax. After tax, that works out to about 8 to 8.5. And with even the best people who invest in stocks, that's about the much that they make after the commissions. So because you're using an expert to invest the money for you, try as much as possible, especially if you have a small amount, if you have only 1 million shillings, if you have only 100,000, just if you don't have the real money for you to be able to diversify as much as possible, put your money in a money market fund and watch it grow, because that's an example of a passive investment. You don't have to do any analysis. There are experts who do the analysis for you, and they will invest the money for you. So in terms of balanced funds, again, these are pooled funds again. Me and you put in money. So I put in my 10K, Stacy puts in his 10, a corporate puts in their 1 million and all that. Then they simply take the stocks. They take the money, they go and buy stocks, they go and buy bonds. This is usually low to medium risk. And then in this case, your capital is not guaranteed, but because it's higher risk, the return is also higher. Because the balance fund today you could have bought at 100 shillings. Tomorrow the balance fund could be worth 120. So by the time you're selling your 1,000, you're selling it at 20% higher than what you actually bought in. So balance funds are good if you're willing to let your money sit for about 2 to 3 years. And again, similar to money market funds, this is you using the power of investors to invest for you, because these are people who understand which stocks to buy, which bonds to put in their money. But remember, there's slightly more risk when you invest in a balanced fund. So invest in one that has been there for a long while, one that is set up by a reputable company, and preferably one that is put up by an insurance company, because insurance companies usually have a lot of their money there and they don't want to lose their own money as well. So that's one way for you to assess a good balanced funds. So just as a reminder, so usually with pooled funds, you get with money market, you get about 8 to 10% interest per year. And it's easy to access your money. It takes about 2 to 4 working days anytime you want to withdraw the money. And the funds are usually secure, but you need to apply due diligence whenever you're deciding. So for me, I have invested with CIC, I have invested with Sanlam, and I have found them to be secure, I found them to be stable. I don't get any commission for mentioning them, so I'm not telling you to put your money there because I will earn anything. I'm simply saying it because in my own personal experience, I have found them to be good and decent enough to work with. So if you're happy to get on with them, you can easily get on the journey with them. So the other thing we look at is treasury bills, and again, looking at this for investment. And I love what was it? I'm trying to remember who gave us the example, but she said that she works at I think it was Stacy. She said that she works at the airport. She's basically figured out a way to diversify an income and to have more income. So what we're saying is Warren Buffett again said that you should never depend on a single income. Make investment for you to create a second source. I can see, Lorna, you have your hand up. You can go ahead. Lorna, if you can hear me, you can go ahead and ask.
Yes. So first, it's a yes. Nanisikia.
Yes, I can hear you.
Nanisikia sasa. Okay. So
loud and clear. We can hear you.
So for me, one it's an observation, and the other one it's a question.
Yes.
Okay, so like for me personally, I'd invested with Saturn because I found that their money market fund was like more favorable to a young person because like the minimum investment was 100 shillings.
Yeah.
But see, you people remember the Saturn saga when like everybody was withdrawing funds.
Yes. I think you've gone on mute, Lorna.
Okay, so now, no, I'm back.
Okay, go ahead. I think you're on mute now again, Lorna.
Yes, sorry, I was saying.
Go ahead, yeah.
Yes, so I was saying now, and people are making like comments like they had invested in too much of something and too less of the other. So, what is that? What are you supposed to like look at, especially when you're looking at a money market fund to invest in, unafaa kuangalia invest in what mostly. And then now my observation is, you still hearing me?
Yes, you can
My
hear you, Lorna. Go
observation
ahead.
for the money. Yes, so my observation for the money market funds, I saw the returns are low. So niliona like for you to reap more from a money market fund, it's not like you're supposed to accumulate a huge amount and then like just stash it mara moja into an account, but you're supposed to like use small amounts and then unaongeza ongeza like now see, and then mostly it uses the compound interest thing, si ndio?
Yes. Yep, 100%. Yes.
Yes, so that's my observation. Like, don't stash a lot of money at once if you're using a money market fund. Like, eka pesa kidogo kidogo, you accumulate like that. Yes, I might be wrong. I don't know, but that was just my observation. Thank you.
So I'll start off with the observation. So I think a part of your observation is right in terms of, because of compound interest and because of you topping up regularly, you will get very good interest. But then if you have the lump sum for you to put in today, you'll still get a very good return. So it works both ways. It works both if you have a lump sum and if you don't have a lump sum for you to invest. So the thing I'm trying to say, just give me 1 second. Sorry about that. As you can see, we all have bosses. So my boss had just walked in. So what I was saying is, what you find about money market funds is that you find them to be, if you're able to use them, and especially put money aside as part of your budget, let's say your 10% of your saving and put it in money market, it will really grow over time because they compound every time. And if you put in the money today, by the time you look at it in 1 month, it will have grown. By the time you look at it in 2 months, it will have grown. Don't look at the amounts as being very small, because if you put in 10,000, you'll only get 1,000, but look at it as a percentage of the overall return, because that's about a 10% return. And it's a lot more than if you took in the time to decide which stocks to buy, spread out your risk. Remember, with 10,000, it's very hard for you to decide, I'll only buy 2 shares of Safaricom, 10 shares of Barclays, 5 of KCB. It's very hard to spread your risk, especially if you have low money. So for me, that's why I think they're very important if you don't have a lot of money. And even if you have a lump sum, but you don't have the time for you to keep deciding which stocks to buy, which ones to sell, then it's still the right way, the right place for you to put in money. So on the question that you asked in terms of what is the way to choose the right money market? So for me, like I said, choose one that is linked to an insurance company. So using the Cyton example, what happened is Cyton were not operating a money market fund. They were operating what is called a high yield fund. So the thing is, what the fund was called, it was called a high yield fund. And that's why they really invested a lot in real estate, because it was meant to be high risk but high reward. But what they marketed it to people, so what they told their salespeople to tell people is that they told them to say that it's a money market fund. So they were simply misrepresenting what their fund was. And that's why when people lost money, they went complaining to the Capital Markets Authority, who's the authority that basically manages money market funds and this kind of funds. And they basically told them that, we can't help you because you invested in a fund that is not a money market. So you losing your capital is part of the risk that you took up when you decided to put your money. So coming back to how to choose the right one, I would say choose one that is linked to an insurance company. So next week, we'll look at how insurance works. And how insurance works is that when you insure your car, they take the money that you pay as premium, they invest it. And then they make money from the money that you've put in. And then over time, because very few people have accidents, the money that they've made from the investment is much higher than the money that they lose by paying out claims when somebody has an accident, when somebody loses their car, it's stolen, and those kind of things. So they still overall make money. So a lot of the money that, if CIC is an insurance company, and we know CIC is an insurance company, the premiums that they collected from CIC, they simply put it into CIC Money Market Fund and CIC Balance Fund, and then they invest that money. So they're not going to lose their own money. So they'll invest it very, very carefully, and they usually attract big corporates as well. So you'll find a lot of banks invest in like CIC, you'll find a lot of corporates, multinationals, they'll invest the funds that they have. NGOs also invest the funds that they collect, because they don't really need to use it every time. So because they attract a lot of big companies, and because they have the name, then you as a small investor giving them your 10,000, they'll still treat it the same way they will treat the 100 million that they get from a bank or from an NGO, from a big company. So that's why I would advise, go for a company that is backed by an insurance company, because you're sure 70, 80, 90% of the money that they're investing is either their own or money that is from very big investors. So you're less likely to lose your money, because they will invest it very carefully, and because they have a lot to lose. If they lose money that is invested by, say, NGOs, I'm not saying like the UN invest with them, but imagine if maybe the UN is one of their companies and they lose money that is put in there by the UN, of course, they have a lot to lose in terms of their name. But if Saiton loses money that they were given by 100,000 Kenyans, even in as much as you complain, you don't really have the big name as an individual for you to hurt Saiton's name. That's why I would say go for a big company that's backed by an insurance company, and one that has been there for a long while, because you would never lose your money with those ones. So I hope I've answered your two questions, Lorna, the question and the observation.
Yep, thank you.
Perfect. So in terms of treasury bills, again, last week we looked at treasury bills and bonds. So this is just a recap. So you can also buy treasury bills and buy treasury bonds for you to use the money use them as an investment avenue. So similar to money market, what you do is you go to the central bank. So money market, you'd go to the insurer or to the money market manager. In this case, you'd go to the central bank, you'd open an account and you say you want to buy treasury bills. They'll tell you which bills are available or which bonds are available for you to buy. So treasury bills are usually short term. They're usually between 3 months all the way till 1 year. And then treasury bonds are usually much longer, because these are about 5 to 30 years. But you don't have to be in for the full 5 to 30 years. At any point, the central bank offers what is called a secondary market, because they understand that you might not be able to keep your money in for the full 5 or 30 years. So they operate a secondary market where you can say, I'm willing to sell, and they then advertise it to potential buyers who are interested to buy your bond, the bond from you. So again, these are usually good for medium to long-term investments. So they're good for investments, especially if you're looking at getting your return within 3, 5, or even 30 years, because they have a slightly better return, and at the same time, they do appreciate in value. But then the risk on the flip side is, if you need your money urgently, you might not be as easy to access, because usually with treasury bills and bonds, they could take between 7 to 10 days. If you say you want to withdraw your money today, they could take between 7 to 10 days for them to give your money to you. So that's just briefly how treasury bills and bonds work. So they're very secure. The return on investments is usually very good. They in fact are much higher than money market in most cases. But then on the flip side, it takes a bit longer for you to access your funds. It can take between 5 to even 15 working days for you to access your funds. So with that, I think we come to the last section, which is other types of investments. So we've not gone through everything today, but there's also other types of investment. So you could decide to invest in land, which is basically you identify a piece of land somewhere you start off the transaction, and based on that, you then wait for it to appreciate in value. You could decide to put your money in a business. With business, remember, for me, my recommendation is usually find a business that has low monthly expenses. So the reason why I've insisted on low monthly expenses is because you don't want a business where you put in 100,000 today, but your monthly expenses, once you put in rent, you put in salaries, you put in maybe other inputs like electricity, water, you have to spend another 100,000 every month. Because remember, whether you make 100,000 or not, you will still need to pay 100,000 in terms of rent, in terms of salary, because the person you've employed, for example, whether or not you make money, you will still need to pay their salary. The landlord, whether or not you make money, you still need to pay their rent. So start a business that you don't need to have very high fixed expenses, and especially rent and salaries. Those are usually the two that kill businesses. The other thing about business is start a service business. So service business is basically a business where you offer a service. A good example could be, I decide to today be doing deliveries. Maybe I can find a place where I buy eggs cheaply and I deliver to people within where I live or around where I live. So that could be a very good service business, because I could decide to move in to a smaller house. Maybe today I live in a 2-bedroom house. I want to move into a 3-bedroom house. Then I use the 3rd bedroom as kind of my store where I put in the eggs or I put in whatever I'm delivering. Then whenever somebody places an order, I simply go to pick from my bedroom, and then I use somebody who I live with, maybe a cousin, maybe an uncle, whatever it is, somebody who we can be able to work together. I tell them, okay, go, please deliver this for me. Or maybe during my free time, I pick up the stuff and I go do the delivery. So with that, remember the costs are very low, because I only needed to add 1 extra room in my house, which is probably going to cost me between 2 to 5 extra thousand in terms of rent. But I don't need to spend a lot in terms of monthly expenses. And if the business does not work out, I can move back to my smaller 2-bedroom house in case I'm not able to afford the bigger house. So others that we've spoken about, I think somebody mentioned Forex as an investment. So it is a good investment, but it is very high risk. And I think on every Forex site, they always say that about between 70 to 90% of their accounts lose all their money. So if you're going to invest in Forex, make sure you understand it well. For me, I'm not the right teacher to teach you anything about Forex. I do have friends who invest in it and make money, but I have tried it and I've really not had any success as myself. So, but people have had success. So it just depends on everyone's risk reward profile. Based on mine, I just found it not to be the right place for me to invest my money. Then the last one is, of course, you have Bitcoins and other cryptocurrency, which you can invest in by deciding to buy or mine Bitcoins, and then ride the wave as the price basically goes up. But again, for me, based on my risk reward profile, that was not the right thing for me. So what we really need to speak as an important point is you need to understand your risk reward profile. So remember that place where you ask yourself, what do you do if your investment today dropped by 10%? Based on you understanding your risk reward profile, you will be able to invest and choose the right investment type and then right investment for yourself. So before I come to the question that I've seen has been put on the chat, I think let me do this quick recap and then we'll come to the question. So first things first, know your risk tolerance. So once you understand, for me, I came to understand that I really can't take shocks in terms of losing money. So for me, I prefer to put my money where I'm sure it is safe. That's why I chose money markets for me. It's passive. I don't have to watch the money grow. I don't have to keep researching stocks. I don't have to research Forex to buy or land to buy and see whether the price is going up or not. So for me, based on my risk tolerance, I found that to be the right place for me to put money. Based on someone else's risk tolerance, they could be the person who loves high energy and loves that the risk of the risk reward. So you're willing to risk a bit more for you to get a lot more. So based on that, you would, if you understand your risk tolerance, you will choose the right investment tool for you. And I cannot stress the point about starting early. So we've talked about this, we've talked about the power of compounding, and there's no better day than today. If you don't start investing today, if you don't start saving today, then tomorrow is one day later. And 1 year later, you will regret why you did not start. Even if you have 1,000, even if you have 500, start early and you will get your return and you will gain a lot more. So final slide. So just I always like ending with a good quote. So this again is from Warren Buffett. Like I said, he's one of the biggest names in investing, so you can really read a lot about him. So he says, someone is sitting in the shade today because someone planted a tree a long time ago. If you want your investment to grow, start today and take advantage of time, because investing is not about turning 1,000 into 1 million in a day. It's about turning 1,000 into 1 million in 10 years. And it's about putting that strategy for you to get there. Otherwise, if you don't put in the strategy, what you're doing is you're betting. There's no difference between you and going blindly into one of the betting apps and saying today Manu will win, and then Manu loses and you lose your money. Investing is about knowledgeably deciding where to put your money. So that's it from me. I can see a question here from Lorna. Just trying to open it. So what you're saying is, quick question, is there a specific time when they advertise the selling of government bonds, especially infrastructure bonds? So to answer that question, yes, the government always has, the CBK usually has advertisements about bonds. They always have a bond coming out every month or every 2 months. So just what I would do is I would go on the CBK website. They always advertise there, and you can see bonds that are coming up within this month. I think in November they did have a few coming up. In December, it's usually not the best of months because December, a lot of government functions usually shut down. But then starting from January again, they will have a bond, almost a bond every month. So you can go to the CBK website and you will see the bonds that are available. In case you're a bit old school, or you have access to a newspaper, you don't have to be old school to have access to a newspaper. So in case you have access to a newspaper, they always, I think it's the Business Daily that usually has a section on bonds. So if you buy, I'm not sure which day it is, it's been a while since I accessed a newspaper, but the Business Daily often has a section where they show the bonds that the CBK has on offer and the ones that are coming up. So, but the best place, especially because I believe all of us have access to the internet in one way or another, the best place is the CBK website. Just go to their website, go to the, I think they have a section on treasury bills and bonds, and you'll be able to see which ones are coming up and which ones have closed. So again, checking in case we have any other question. I'm not seeing any on the chat, but in case there's any other question, please feel free to unmute. I believe we are at the end of today's session. So Lorna, you're saying thank you. You're most welcome. And I hope you've been finding this useful. And again, if there's anything that you think has not been covered, or a specific question you have, feel free to always ask. This session is for you. Okay, since we don't have any more questions, I would say thank you very much. You have been an awesome audience, and I look forward to seeing you next week in the last class, where we talk about how to protect your investment. We've talked about investing. The next part will be now about how to protect it. I can see a question here. You're asking, I'm not able to pronounce the name, but you're asking, just a clarification, kindly, would you explain again how balance funds work? Okay, so balance funds are basically pooled funds. So what pooled funds are is, I put in my 10,000, you put in your 10,000, Lorna puts in her 10, Ruth puts in her 10. So in the total pot, we maybe have 50,000. Then we invested this balance fund with an investment manager. So let's say it's offered by, for the sake of just using an example, maybe we put in our money into Britam Balance Fund. So I brought in my 10, you brought in your 10, and then the total pool of money was 50K. So Britam, as the asset managers, take that 50,000, and then based on their expert knowledge and analysis, they invest in stocks and they invest in bonds. So they diversify, they decide, okay, they believe these stocks will grow, so they put some money in stocks. They decide, on the other hand, there's some bonds that will grow. So they invest in bonds as well. So based on that, what happens is, by the end of a period, they then say, our 50K is now worth 60,000. But then they usually indicate the value similar to how stocks work. So what they do is they say, today you bought in when the balance fund was at 100 shillings, but because the balance fund has appreciated in value, it's now become worth 120. So if you were to buy one unit, it would be 120. But it's the same principle of people having pooled funds. It's people brought in different money from different sources that was then invested. Then the thing about balance funds is the price could also go down. So if they bought stocks where the value went down, then if you bought in at 100, you could easily see that the price, if you were to sell today, becomes 95. So you'd have lost about 5 shillings for every unit that you had invested. So balance fund usually has higher returns. So if you actually look at the impact of, I think there was a nice chart, I could find it and maybe show it in the next session. I'll try find it and show it in the next class. There was a nice chart that basically showed that if you want to keep your money in balance funds, over 2 years, you get a much better return than if you put your money for between 6 to 12 months. The reason for that is because balance funds are basically like stocks. So they go up, they go down, they go up, they go down, but then net, they basically go up over time. So if you want to ride the wave, the minimum for you to ride the wave is 2 years. So if you bought at 100 today, give yourself 2 years, then you'll have sold at maybe 150, which would be a return of about 25% per year. So they have a much better return than money markets because they invest in slightly higher risk, but then the return, of course, is higher. And again, you're only taxed on the interest that you make on your income. You're not taxed on your full income. So I hope I've explained how balance fund works, but in case there's any question, you can feel free to again type it. So Lorna is asking, are they different from equity funds? So there's the three of them. So there is money market, there's equity funds, and then there's balance funds. So money markets, as I said, is low risk. They basically invest in treasury bills and treasury bonds. Balance funds usually balance out between, the reason why they're called balanced is they balance between bonds, they balance between equities, and then equities are on the far side because equities just invest in equities. So an equity fund is basically you're investing and the investor takes the money and invests in stocks. So the thing with balance fund and equity funds is that they're higher risk than money markets. But then the thing about equity funds, they're slightly higher risk than balance funds, because remember, balance funds have balanced out the risk by investing both in bonds and in equities. But equity funds are higher risk because they've only invested in stocks. So it's higher risk, higher reward, medium risk, medium reward, and low risk, low reward. So I hope I've answered those two questions on balance funds and equity funds. But in case there's any other question, again, I'm happy to answer. So Lorna, you say, yep, you are welcome. Cool. Stacy, you're saying thank you. You are most welcome. So again, thank you very much for joining this class. You have been awesome. So next week we finish off the class and we all get our certificates for attending this course. So thank you very much to everyone who has been an awesome, awesome audience. So have yourselves a good evening, guys.